Picture this. You've spent months, maybe even years, saving every penny. You've researched neighborhoods, pictured your kids playing in the backyard, or sketched out the business plan that's kept you up at night, buzzing with excitement. You walk into that bank, documents in hand, a nervous but hopeful energy coursing through you. This is it, the moment that could change everything. You sit across from a loan officer who offers a practiced, sympathetic smile. They type a few things into their computer, the clacking of the keys echoing in the quiet office. Then, the smile falters slightly. They turn the screen away, clear their throat, and deliver the line, "I'm sorry, but at this time we're unable to approve your application." The words hang in the air. Denied! But why? You have a steady job you've been saving diligently? What did you miss? The answer isn't in that room. It's not a decision made by the person in front of you. The real decision maker is miles away, housed within a vast, humming server farm. It's a complex, invisible system, an algorithm, that has sifted through your entire financial history in a fraction of a second. And based on its calculations, it has passed a verdict. It has stamped your file with a single, powerful word: unworthy. This isn't just about a single loan. This is the hidden architecture of our modern economy. These silent judges, these credit scoring algorithms, don't just determine who gets a mortgage or a car loan. They can influence where you live, the job you get, even the insurance rates you pay. It's a system that affects billions of people worldwide, yet most of us have no idea how it truly works. Did you know that in the US alone, over 200 million adults have a credit score that is constantly being updated and analyzed by these systems? So it begs the question, who are the architects behind these powerful lines of code? What biases, what assumptions are baked into their logic? And most importantly, in a world increasingly run by automated decisions, have we handed over the power to define human potential, our dreams, and our very worth to a machine? In this video, we're going to pull back the curtain on the secret world of credit scoring. Before computers crunched our data, getting a loan was a deeply personal and often deeply biased affair. You'd sit across from a loan officer who judged you on the firmness of your handshake or the neighborhood you lived in. Your financial fate rested not on objective numbers, but on his intuition. For many, especially women and people of color, this system was an impassable wall, locking them out of homeownership and entrepreneurship. The decisions were inconsistent, opaque, and fundamentally unfair. But in a small San Francisco apartment, two minds saw a different future. Engineer Bill Fair and mathematician Earl Isaac believed they could replace this flawed human judgment with the cold, hard logic of mathematics. They hypothesized that past financial behavior could be distilled into a single predictive number. A number that would be fair, consistent, and blind to race, gender, or social standing. It was a revolutionary idea, to democratize credit using data. They called their new venture the Fair, Isaac and Company. And the score they created? FICO. The banking industry was immediately captivated. Here was a tool that promised to be faster, cheaper, and most importantly, objective. It could process thousands of applications in the time it took a loan officer to review one. The promise was tantalizing, a level playing field where only your financial responsibility mattered. But a promise, as we know, can be a fragile thing. Over the decades, what began as a tool became an inescapable gatekeeper. Your FICO score began to dictate more than just your mortgage rate. Could you rent that apartment? Get that job? Qualify for a reasonable insurance premium? Today, FICO and similar algorithms process trillions of data points. It's not just your loan history. It's every credit card swipe, every late utility bill, your credit utilization, and sometimes even the time of day you make a payment. Have you ever stopped to think what story your data is telling about you? That story determines the opportunities you're given and the ones you're denied. A credit score isn't just one number. It's a calculation based on weighted factors. Payment history, 35%. Amounts owed, 30%. Length of credit history, 15%. New credit inquiries, 10%. Types of credit, 10%. Simple, right? Except, no one outside these companies knows the exact formula. It's a trade secret, a black box. Even regulators don't fully know how some algorithms weigh different factors, leaving millions of people at the mercy of unseen calculations. For Sarah, a nurse in Ohio, one missed payment during a medical emergency dropped her score by 70 points. Overnight, she went from being a prime borrower to high risk. For Jamal, an entrepreneur in Lagos, having no credit history at all meant banks treated him as invisible. The algorithm doesn't know Sarah was saving lives that night, or that Jamal's business turns a profit. It only sees the data. The last decade has seen a quiet revolution. As our lives moved online, credit scoring followed, evolving from a national system into a global phenomenon. The old models, based on a handful of data points like loan payments and credit card debt, were leaving billions of people behind. So, innovators turned to a powerful new tool: artificial intelligence. Nowhere is this more apparent than in China. Systems like Ant Group's Sesame Credit have created a new paradigm of social and financial assessment. It's not just about if you pay your bills. The algorithm analyzes your shopping habits, your educational background, the punctuality of your utility payments, and even the credit scores of your friends and contacts. With over 1 billion users, it has woven itself into the fabric of daily life, determining everything from loan eligibility to rental deposits. And this trend isn't confined to China. In the West, a wave of fintech companies are using AI to analyze what they call alternative data. They're looking beyond traditional credit reports to build a more holistic picture of you. This includes your rental history, your phone and utility bill payments, your educational attainment, and even your public social media activity. Have you ever considered what your digital footprint says about your financial responsibility? The promise is enormous. This technology could finally open doors for the credit invisible, the millions of people, like recent immigrants, young adults, or gig economy workers, who are shut out of the traditional financial system. An AI might see the steady income from a freelance career and grant a loan that a bank would automatically deny. But there's a dark side. What happens when an algorithm learns to associate shopping at a certain store with being a higher risk? Or penalizes someone for living in a low-income zip code? This is digital redlining. Without careful oversight, these systems could create new, deeply embedded forms of discrimination that are harder to see and even harder to fight because they're hidden inside a black box. These algorithms aren't just technology. They are power. Power to open doors or close them. And the unsettling truth? Most of us never gave them permission to rule our lives. So who decides your worth? A banker, a government, or a line of code written years ago by someone you'll never meet? Change is coming. Some countries are pushing for transparent scoring models. Open banking initiatives let you see and challenge the data behind your score. The next battle? Making sure the algorithms that judge us are fair, explainable, and accountable. In the end, your worth is more than a number. But until the systems change, numbers decide. And numbers remember. Understand them, question them, and never let them define you entirely. This is the algorithm effect.